Welcome to the Capital News. I'm your host, Alex Karitis. Today is Tuesday, November 24th, 2020. Thank you so much for joining me. Title of today's podcast, Yellen, no checks, no balances. This is going to be a continuation of some of our analysis from yesterday's podcast titled Yellen and Screamin' with regards to former chair of the Federal Reserve, Janet Yellen, is getting the nod to become the next Secretary of the Treasury. So I hope you're sort of catching the little play on words from yesterday's podcast, and of course today's as well. No checks, no balances, because this is a first world banana republic. Okay? We have no checks. They're going to bounce because we have no balance, because we have to print the money to throw it into the Treasury Department to make it seem like we actually have something. That's where we are. This is us. This is the state of the United States of America. This is the state of our union. It's a disgrace, it's an embarrassment, and it's only going to get worse because there are no adults in the room. There are these jokers at the helm, and it's just a revolving door down there in Washington, D.C. Somehow, President-elect Joe Biden and Kamala Harris think it's a great idea to bring the gang back together. Let's put the band back together. Clearly, they did not get the memo. If everything was so great during the Obama-Biden administration, Hillary Clinton would be president of the United States. These idiots can't wrap their minds around this fact. Or maybe they do, and they just don't care. They're just going to bring everybody back right into the fold. John Kerry, Janet Yellen, people within the State Department who work very closely with Secretary of State Hillary Clinton. All these people that were in the Obama-Biden administration, they're all coming back in some shape or form. That is not what the country voted for. That is not where the country is. Now, I can understand from a standpoint that you're going to bring some of these people back because these are the people you're comfortable with. These are some of the people you trust. But you have to go out on a limb here, Mr. Biden. You have to surround yourself, if you will, with a team of rivals like Abraham Lincoln did in this time of division. You have to have other ideas circulating around the White House. But they don't care about us, so this is not going to happen. And by these actions, we see who they care about and what they're doing. This is why these people don't earn your respect. They don't earn your trust. You shouldn't give them a second of your time. And most definitely not your vote, because they do not deserve it. And I really do not know how much more evidence you need to see, but clearly people still out there need to see more evidence. Unfortunately, by the time most people wake up, if they ever do, it's going to be because we've hit rock bottom. So, no checks, no balances. We're going to go today over Janet Yellen's tenure at the Federal Reserve, what she oversaw, some of the things that she now believes in, and I'm sure she believed these things for a long time, but now there's just sort of coming out into the mainstream as to sort of how she thinks monetary policy should behave in the years ahead. Now, one of the most concerning things that she thinks should be considered is that the Federal Reserve should buy equities, stocks, outright. Let me repeat this. Janet Yellen thinks that the Federal Reserve, when the time comes, should be given the authority to go out and buy stocks. Now, of course, she's careful to word this. Not yet. But it's something that the Congress should consider. The Congress should consider expanding on what the Federal Reserve is able to do. Now, if everything was fantastic, if there really was this super-duper miraculous V-shaped economic recovery, then why, oh why, Would we need to print more money to buy equities now? Because we're buying across the yield curve with respect to the Treasury market. We've been doing that for years. They're buying mortgage-backed securities. They've been doing that for years since the great financial crisis. That was basically residential. Now they're doing commercial because that market is still in free fall. They're buying corporate bonds on the secondary market, meaning directly from investors who held those bonds, and also on the primary market, meaning directly from those companies issuing said debt. That's investment grade and junk. Well, we're junk status here too. And we're going to talk about the federal funds rate a little bit, because if we got back to where we were during the great financial crisis, it'd be game over for this economy. Now, that's what needs to happen, but it would be game over. I think even if we got back to where we were with respect to the federal funds rate in the fourth quarter of 2018, this would be game, set, match for this economy. That's how fragile it is. That's how fake and phony it is. And this should be very, very apparent to anybody who is paying attention. But most people don't want to pay attention to this. They don't want to believe it. I understand it. I don't like talking about it. But somebody has to mention this to you. Somebody has to prepare you for what is likely going to happen. And furthermore, just on the principle of the matter, this is not what we stand for. At least it's not what we're supposed to stand for as a country, as a people, as Americans, which goes to the other purpose of today's title, no checks, no balances. Because the Federal Reserve shouldn't even be a standing institution to begin with. You have the judiciary branch, the legislative branch, the executive branch, all established by the U.S. Constitution, all there to keep an eye on each other. Checks and balances. Congress passes a law, president doesn't like it, he can veto it. If there's enough support for that law, Congress can override such veto. Congress passes a law, the president signs it, it's an overreach, somebody can take that to the Supreme Court. The Supreme Court can overrule it, can determine it to be unconstitutional. And round we go. People get elected, people get voted out. Federal Reserve, there's no accountability, there's no responsibility, there's no checks, there's no balances. Those 12 idiot eggheads sitting around a big table deciding what the price of capital should be is what it's going to be. The president isn't going to overrule them. The Senate, the House of Representatives, the Supreme Court, nobody. These are unelected officials. They are appointed by the president, confirmed by the Senate, and a lot of them are even appointed really behind closed doors by the banks. And then, of course, the politicians do their bidding. Oh, promote this person, appoint this person, confirm this person. You want to get reelected, don't you? You'd like some campaign money, wouldn't you? This is the system. This is the game. This is why these people just keep coming back and forth, because this is who the system is comfortable with. They know these people play ball. Not for you, the people, but for those who are closest to this power. Those who are closest to this source of liquidity. That's why we see such massive wealth and income inequality in this country, around the world. This is a recipe for disaster on the political front, social front, economic front. It's already before us. This is why people have been protesting globally. This is why people have been rioting. This is why people are staging coups, overthrowing their governments, or attempting to do so. And it's one after the next. And it is going to happen, unfortunately, in this country as well, because there is no leadership. There is no honesty. And my next letter is going to be to my U.S. senators, because they are going to have a vote, obviously, with respect to Janet Yellen And I imagine I will share that letter with this audience, but I haven't yet decided that. But I would like to. And of course, it's going to be stating her record and why she is unqualified and does not deserve to be the Treasury Secretary, and why this country does not deserve to have her there. What are they going to do? Well, I have a Democrat and I have a Republican senator. We'll see. We'll see. But they are going to hear my opinion on this in writing, because that's how important this is. This is enough. But most likely they're going to vote her in because they've confirmed her before to be the vice chair of the Federal Reserve, to be the chair of the Federal Reserve. So why wouldn't she get confirmed to be the Treasury Secretary? And of course, she's a woman, right? She would be the first female Treasury Secretary. So who's going to vote against that, right? Going to be some sexist pig. It's like voting against the Patriot Act. Well, you vote against it, you're unpatriotic. You vote against the CARES Act, well, you must not care. Now, up in the bullpen, we have the HEROES Act. Well, if you don't vote for the HEROES Act, you're against heroes. Really take you for stupid. You understand this. So we're going to get to some of that. But first, market performance. Well, records on Wall Street. And why not, right? But we have the dollar index getting hit, down about 0.15%, I should say, trading at 92.08. So we are flirting with lows with respect to the dollar index that we have seen earlier this month. This does not look good for the U.S. dollar at this juncture. This is no surprise. If it keeps going down, I won't be surprised. I still hold to my argument that there is still a possibility of a final swan song, if you will, meaning that the dollar could gain some strength over the next year or so, and then that will be it. Because what we are going to be entering next, folks, is going to be a bond crisis, sovereign wealth crisis, if you will. We're going to be entering a currency crisis, interest rate crisis, and that's also going to bring the stock market down with it. But people are going to say the stock market, that's almost going to be second fiddle. Because the size of the currency market, the bond market, the interest rate market, I mean, that just dwarfs the stock market. But this is where we're headed. We are headed towards collapse because this is unsustainable. Completely unsustainable. So that's the dollar index. And of course, this weakening of the dollar is pushing up commodity prices, which of course we'll get to. But we have the Dow Jones Industrial Average currently up, and overnight futures trading up about 0.1%, slightly north of 30,000 points. And of course, the President of the United States came out today. I didn't see it live, but I heard about it. I guess him and Vice President Mike Pence came out in the press room at the White House, and he was only up there for like a minute or something, and just basically said, well, the Dow Jones Industrial Average hit 30,000, and then just walked away. Oh, good. Good, because that's your job as President of the United States, to keep us updated on the stock market. I remember reading that in the Constitution, actually, Article 2, Section blah, 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 blah. From time to time, the President will notify the people of the current status of the Dow Jones Industrial Average. See you later, pal. Enjoy your golf. We have the S&P 500 currently up about 1/3%. The NASDAQ 100 is also up about 0.5%. Again, overnight futures trading. Cash trade in Japan is up another 0.6%. Big, massive gains across the pond in Europe as well, anywhere from about 1.25% to 2%, depending on the index. Cash trade in Australia also gaining 0.2%. Strong rally across the board again with respect to tech stocks. Apple up 1.2%. Tesla up another 6.4%, putting on another 33.5 points, now trading at 555 points. Why? Why not? This is the poster child for the everything bubble. Make no mistake about it. No profits? No problem. Let's put them into the S&P 500. Microsoft gaining about 2% for the day. Amazon gaining 0.2%. Alphabet, the parent company of Google, gaining 2.1%. And to round it out, Facebook gaining 3.2%. On the commodity front, Oil is hitting a fresh 8-month high. WTI is trading at $45.29 a barrel. Brent is at $48.30. Natural gas at $2.74. Gold and silver still gaining no favor in these markets. Gold is now trading at $1,805 an ounce, flirting very closely with that $800 threshold, very important psychologically and technically, and the chart does not look pretty. Silver still, however, is somewhat hanging on. Not the prettiest of charts, technically speaking, but it's still hanging on. $23.23 an ounce. Look, I am still very much a long-term bull when it comes to gold and silver, especially with this idiot coming into the Treasury and with the current idiot as the chair of the Federal Reserve. I mean, this is basically a match made in heaven or a match made in hell, however you want to put it. But this is going to be good for gold and silver over the long term. We know these markets are greatly manipulated because J.P. Morgan just paid $920 million, admitting to the fact that they manipulate the precious metals market. I think there was another fine of about $250 million that they had to pay to the Office of the Comptroller of the Currency, OCC, the Office of the Comptroller of the Currency, for rigging some other markets. And remember, the CEO and chairman of J.P. Morgan Chase, Jamie Dimon, was supposedly on the short list potentially to become the next Treasury Secretary. These are the people who they give us. And we just have to take it. And this is who people voted for, who then go forth and appoint these jokers. But can't connect the dots. You can't see it. You keep voting for them. And you wonder why. Uncle Sam's 10-year junk note. Again, because that's what we are. A first world banana republic. This is junk. But the 10-year note is yielding 0.88%. You would think, again, that this yield would be even higher. But it's not. This is supposed to be risk on. Everything's supposed to be great and gravy. So why is this still with an 8 handle? Why isn't this well north into 0.98? Why aren't we back at 100 basis points? What's going on? We know what's going on. We know what's going on. Out of a survey from the Census Department, and highlighted here from Bloomberg, we have 5.8 million adults. 5.8 million adults saying that they are likely to face eviction or foreclosure in the next 2 months, accounting for 1/3 of the 17.8 million adults in households which are behind on rent or mortgage payments. You got that? And there's a chart titled Dark Winter. A couple months. It's going to be a very Merry Christmas and Happy New Year for a lot of people. Percentage of adults living in households not current on rent or mortgage, where eviction or foreclosure in the next 2 months is either very likely or somewhat likely. And this is a heat map that they put together, and it goes from blue to red. So, of course, now we're back with the blue and red states, but for a different reason. So, if you're anywhere from 0% to 21%, you're a blue state. Your blue states are Maine, Vermont, New York, and Hawaii. That's it. 0 to 20%. Then you have your gray states. Some of the mentions here are Texas, Washington, Minnesota, Missouri, Virginia, and Pennsylvania, and New Jersey. And there are several others, but those are just some of the bigger states. And then every other state, for the most part, is red, meaning anywhere from 31 to 50% of adults living in households not current on rent or mortgage, where eviction or foreclosure in the next couple of months is very likely or somewhat likely. Yet the stock market is making all-time highs. And the president comes out to, I guess, pat himself on the back, even though he told us if Joe Biden gets elected, the stock market's going to tank. So you solved this riddle. You figured that one out. Now we have commodity prices taken off. Now we'll see if this continues. But this, of course, is the excuse. The headline economy is now, we have so many vaccines coming to market. Everything is going to be A-okay. OPEC is maybe going to delay more production runs, so okay, demand's going to pick up, supply's not, so okay, prices are going to go up. At a time when we have nearly 6 million people facing eviction or foreclosure over the next couple of months, 12 to 14 million Americans potentially going to lose their unemployment insurance benefits by the end of this year, early next year. Tens of millions of people in food bank lines. The hits just keep on coming. Stock market's making all-time highs. Commodity prices are going up. Food prices will also be going up. This is the effect of all of this funny money. This is the effect of living in a first world banana republic. Want to buy? Shelves are empty. People are going hungry in Venezuela, in Zimbabwe, in Lebanon, in Syria, what's likely to transpire in Turkey, what might even happen in South Africa, and so many others. This is what happens. These are the consequences. This stuff is real. And we are doing the same thing. Completely destructive to our society, our economy, moral fabric, everything. It's gone. We have all been turned into commodities. And most people don't give a damn, especially if they hold some financial assets. If they're a homeowner, well, the price of my house is going up. Fantastic. I don't care if I sell it to some sucker at the height of the market. That's his problem. That's his problem. Stocks keep going up. Not because of sound economic principles, productivity gains and the like. No. Because we're printing money and it has to go somewhere. Well, that's where it's going. So my 401k is up, my IRA is up, my stock portfolio's up. I don't care why. It's up. And then people have the audacity to pat themselves on the back and claim that they're smart. Because stocks go up. Because they're printing money. Like it's going out of style, because it is. Very easy to see. Most people don't want to admit it. That's part of the problem. So just at a time when you have all of these people suffering, things that they depend on, food, energy, utilities, all those prices are going to start to go up. All of the small businesses that are fortunate enough to still be surviving, well, now their costs are going to go up too. This hurts them disproportionately to larger companies. These higher prices disproportionately hurt those in the lower income brackets because they spend a disproportionate amount of their income on the necessities. Very easy to understand this. So this is likely going to be a dark winter, as the title of that Bloomberg chart outlines. So that's some of the market performance. These are just some things to ponder. So getting back to Janet Yellen and company. So she was the vice chair of the Federal Reserve from 2010, I believe it was, to 2014. And then from 2014 to 2018, she became the chairman of the Federal Reserve Board. But very much in agreement with what Ben Bernanke and company did. And of course, the current chairman of the Federal Reserve, Jay Powell, worked with Janet Yellen. So just for some historical context and perspective, and I have stated this many times before, we go into it in greater detail in our book, The Cynic's Guide to Investing. But in the midst of the great financial crisis, and what I'm looking at right now is the balance sheet of the Federal Reserve. And of course, we look at this every Thursday. This is part of the data dump that comes out every Thursday that we discuss. So this is the balance sheet of the Federal Reserve during the great financial crisis, the largest financial crisis and recession since the Great Depression. They come up with quantitative easing. In the midst of this, we are looking at a balance sheet of $905 billion. So we are still south of $1 trillion. The Federal Reserve was founded in 1913, opened its doors in 1914. That entire history, from 1914 to 2008, we were south. We were below $1 trillion. All of this chaos, pandemonium, we got to do something. Let's do quantitative easing. Let's expand our balance sheet. And we go from $900 billion up to slightly over $2 trillion in a very, very short period of time. Just a couple of months. Now, when you look at economics, there's sort of, it has its 10 commandments, if you will. The first few are understanding the law of demand, the law of supply, and diminishing marginal returns. And as we have stated repeatedly here, as we have stated in our book, The Cynic's Guide to Investing, they are going to continue with this nonsense, but it's going to take bigger doses to get the same type of hit. That's diminishing marginal returns. And that's exactly what we are witnessing right now. And if you were to pull up the Federal Reserve's balance sheet, you would see this step-like pattern of this just increase after increase after increase. And you can pretty much time out these increases in the Federal Reserve's balance sheet with how the market responds, the stock market primarily. Because, I should say the bond market as well, but these are the conniptions that the market has. These are the addicts. We gave them training wheels. We gave them an extra dose. We gave them more cocaine, more crack, more heroin, whatever analogy you want to use it. We start taking these training wheels off. We start taking away the drugs. They go through withdrawal. They fall off the bike. Got to go right back to it. This is reminiscent of the Alan Greenspan, who was a former chairman of the Federal Reserve. This was the Greenspan put. Anytime there was a conniption in the market, don't worry. Alan Greenspan has your back. How'd that work out? Well, it didn't. Led to the dot-com boom, led to the dot-com bust. NASDAQ losing 80%. Don't think it can't happen again. That was only 20 years ago. Make no mistake about it, it can and it most likely will. Okay, so you have quantitative easing 1. You have that big jump of over $1 trillion in a very short period of time. And you can see this again. You see a little bit of volatility, but it's stabilizing. And this is playing back and forth, seeing how the market can take it. Can we give some more, take it away, give some more, take it away? What happens? Because this is an experiment. We're the test subjects. Okay, that's why this is so dangerous. And this is not going to work well. You have quantitative easing 1. You have quantitative easing number 2. You have Operation Twist. Quantitative easing number 3. Now we're on to quantitative easing number 4, QE infinity, whatever you want to call it. It's all a bunch of funny money at this point. But you have a little period of consolidation, if you will, from 2008 to about 2010, end of 2010, where you stay around $2.3 trillion on the Federal Reserve's balance sheet. All right, now at this juncture, Janet Yellen's there. This is 2010. They do it again. So you go from 2.3 trillion to 2.8. So that's another $500 billion. Now you say, well, that might not be that big of a deal. Remember your history that I just noted. It took us nearly 100 years to get to 900 billion. Now we're going trillion, $500 billion. This is a big number. Then there's another period of consolidation. Let's call it from 2011 to the end of 2012. Hanging around, 2.8 trillion. And then we take another big step up. And let's just take it to the peak. About 4.5, 4.6 trillion. So almost another 2 trillion. Over another short period of time. And we hung out there for quite a while. From 2014 to about 2018. And we started to let the balance sheet roll off. Weren't buying that many more bonds and notes across the yield curve. Those that were coming to term, we were allowing those to expire. And even at this juncture, interest rates, the federal funds rate, was also starting to increase. And then as we talk about here all the time, there was a hissy fit by the President of the United States and Wall Street in the fourth quarter of 2018. And boom, down goes the stock market, 20%. Then, and now, Chairman of the Federal Reserve, Jay Powell, he says, okay, my bad, shouldn't have done that. Put things on pause, starts jawboning the markets. We're not going to increase interest rates anymore. And then they started dropping them, expanding the balance sheet again, and here we are. But now, with COVID-19 amongst us, this gives these people cover to justify the unjustifiable. And so the great financial crisis, they expand the balance sheet very quickly, very rapidly, by about $1 trillion. This time, however, because of diminishing marginal returns, we got to go even bigger. And we go from $4.2 trillion in March to where we are today at $7.2 trillion. So we just threw an extra $3 trillion into the system, the drop of a hat, like it was nothing. So 3 times, basically, what we did during the depths of the great financial crisis. They did this almost immediately this time around. You think they weren't waiting for this? All of those emergency facilities that they have? They've just been in a top drawer collecting some dust for a little while. They knew it was coming, and they were ready to act. And this isn't free. And this is courtesy of the Nobody Cares Act, 96-0, no votes for America. Don't you ever forget. This is what Janet Yellen oversaw. This is what she endorses. Federal Reserve's balance sheet of $7.2 trillion is just getting started. It's going to go much, much higher. It's going to go higher with the blessing of the Federal Reserve. It's going to go higher with the blessing of the new Treasury Secretary, Janet Yellen. And it really doesn't make any difference who it was. The next Treasury Secretary would sign off on all this too. But it's just despicable that it's this woman, because she's been there and has done enough destruction to this country as it is. And then lastly, I know we're getting towards our time limit that I like to keep it to. Federal funds rate, and we'll continue this conversation too. Couldn't tolerate 2.25%, 2.5% in 2018. Really closer to 2.5%. But right now we're back to that lower bound, nearly zero. Nearly zero. We're at 9 basis points right now at the effective federal funds rate. Where were we before the dot-com bust? 6.25%, 6.5%. Where were we before the great financial crisis? 5%, 5.25%. We're junk status now. Back then, we weren't on the right path, but we weren't junk. We are today. We are today, thanks to Bush, Obama, and Trump. We are junk status right now. Which is why our yields, which is why our borrowing costs should be much, much higher than what they are. Which is why when I go through the market performance segment, I always say, looking at Uncle Sam's 10-year junk note. Because that's what we are. Call a spade a spade. We're junk. This isn't investment grade material. This is a disgrace. This is an embarrassment. We are junk. At a minimum, these rates should be back to where they were prior to the great financial crisis. Back to 5%. There's no way we could tolerate that. No way. 20% of U.S. firms are zombies? Give me a break. It's only going to get worse, by the way. Go back to the dot-com bust? 6.5%? There's no way. But that's where they need to be. And in fact, it should probably be even higher than that. That's what would put an end to all of this nonsense. That's what would wake people up. But they don't want people to be woken up. They want people in their zombie-like state. They want you in your respective silos. They want the people fighting themselves. They want the people arguing about wearing masks or not, keeping a statue up or not, eating a Goya bean or buying another brand, and a whole bunch of other social and cultural nonsense to keep you distracted while they run away with trillions of dollars that they print out of thin air and give it to their buddies. It's right in your face. It's as clear as day. This country needs to wake up. But that's the system of no checks and no balances. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.